Today, we're diving into an analysis report on Next NRG, or NXXT, titled 232% Revenue Growth. Wow. NXXT stock explodes on massive earnings beat. It's a really strong piece, but we see 3 key ways to tighten up the structure and really lock in the argument.
And we should probably jump right in with the trickiest part, which is always how you handle mixed results.
Exactly. The crucial context of the mixed results, you have this huge revenue beat versus a pretty clear EPS miss. It just needs tighter narrative control to, proactively guide the reader's interpretation.
That's the core tension, right? The weakness we see is structural. In Section 2, the report just lays it all out. The massive $22.9 million revenue beat is immediately followed by the EPS miss. It's a negative 0.11 loss, when a negative 0.05 loss was expected.
And by putting the full financial picture out there first, the contradiction, before you give the justification, the reader's first reaction is almost inevitably going to be negative.
It has to be.
So while the analysis tries to frame it as a growth play, that argument comes after the raw numbers. And that just risks sounding, defensive.
Like you're making excuses for the data. But the thing is, the report already has the perfect tool to fix this. So our suggestion is to immediately integrate the operational evidence, the margin improvement, to validate why the market chose to focus on revenue.
So you reinforce the growth play thesis with hard data before you even state it as like a market narrative.
Precisely. You're using the company's own metrics to answer the question, why did the stock jump if they missed on earnings, before the reader even has a chance to fully form it.
Okay, so what does that look like in practice? What's the actionable change to the sequence?
You resequence it. So after you present the 22.9 M revenue versus the minus 0.11 EPS miss, you don't jump to the market story. Instead, you immediately introduce the margin improvement data. This is what the report calls Catalyst #1.
The gross profit margins jumping from 8% to 11%.
That's the one. It's a significant move.
That is a strong shift. It's one thing to say the market reacted positively, but it's fundamentally more convincing to show why using the operating leverage. So how do we phrase that? How does that become the analytical bridge?
Well, you use that data point to explain the disconnect right away. The analysis could say something like, the move to an 11% margin proves rapid operational leverage as Next NRG scales. This tangible proof of efficiency is what validates the high growth valuation, despite the short-term EPS gap.
I like that. It anchors the whole bullish case in a specific measurable success. So the argument goes from being a story to, being an equation. The $22.9 million in revenue plus 11% margins equals justification for the stock exploding.
Exactly. You control the narrative from the very beginning. You're telling the reader exactly how to interpret those two conflicting numbers.
Okay, that makes sense. Let's move to our second point then, which deals with the long-term risk profile. The report does a good job listing the major risks. A net loss of, negative $14.9 million this quarter?
And the potential drag from dilution, right? The rising share counts.
Yes. That's all there, which is essential. But to really elevate the bullish case, the report has to establish a clear functional link between the positive catalysts it identifies and these primary risks.
Right now, those two sections, the catalysts and the risks, they feel like they exist in a vacuum,
They're just sort of listed separately. The report mentions positive things like improving margins and CEO confidence, but it doesn't explicitly spell out how those things neutralize or shorten the timeline away from the existential risk of running out of cash.
The reader's basically left to connect the dots themselves, which is a huge missed opportunity. If the risk is massive cash burn, the analysis needs to frame the catalysts not just as good signs, but as specific inputs that project a path away from having to constantly raise capital.
You're saying we need to give the reader a kind of scorecard for future earnings. Define what success actually looks like in managing that minus $14.9 million loss.
That's it. It turns the risks from just being warnings into measurable challenges.
Okay, so let's make that concrete. The CEO's actions around capital. How can we integrate that into the risk discussion more effectively?
So we should take the CEO's action settling debt by taking stock at $1.04 a share and put it directly into the risk section. That move is a direct signal about management's internal timeline for profitability.
So instead of just saying, oh, look, insider buying, we frame it as a risk mitigation signal. What would that sound like?
You could suggest that this specific move indicates management believes the current dilution window is short, that they're projecting profitability before the stock has a chance to drop back near that $1.04 level.
It turns a historical action into a forward-looking indicator about their own risk tolerance.
It's management putting a price target on their own confidence. It directly addresses the dilution risk.
That's a much more sophisticated way to read that move. Okay, now what about the other big risk? The cash burn, that negative $14.9 million net loss. How do we connect the margin improvement to that?
We absolutely can. We challenge the margin data against the cash burn. The analysis could literally ask the question, what projected quarterly revenue at this new 11% gross margin would be needed to break even on the $14.9 million loss, assuming, fixed costs stay relatively stable?
That's basically back of the envelope math, but it gives an investor a really crucial milestone to watch for. Is there a risk that's too simplistic, though? I mean, fixed costs can fluctuate.
That's a valid point, and you'd have to acknowledge that. The goal isn't to build a full financial model here. It's to provide a strategic framework. The benefit of giving the reader that clear revenue goalpost, I think, far outweighs the simplification.
So you make it clear that this number, let's say it's X million in revenue, is the minimum target they need to hit to stabilize the ship.
Right. The whole discussion shifts from a passive warning, hey, be careful they're losing money, to an active, measurable objective. This is the hurdle they have to clear. It changes the conversation from will they survive to how quickly can they get to X million in revenue.
That's powerful. All right, let's pivot to maximizing the immediate momentum narrative. This relates directly back to the headline, right? Stock explodes. The report has this potent forward-looking piece of data, the preliminary October revenue, but it feels underutilized right now.
That's the third big opportunity. The data showing October revenue is already up 196% year over year. What the report calls Catalyst #3 is just buried deep in the Catalyst list.
It gets lost.
Completely lost. The weakness is that its freshness, the proof that the Q3 growth wasn't just a one-off fluke, is totally diluted by where it's placed. By the time the reader gets to it, the impact is gone.
Right, because it's separated from the core Q3 announcement that caused the stock to explode in the first place.
And that October data is the perfect link between what just happened and what analysts think is going to happen. So our suggestion is to elevate that 196% October data. Use it as the critical bridge between the historical Q3 performance and those super aggressive analyst price targets.
The $550 average target, the 350% upside?
Exactly. You use it to reinforce the explosion angle by showing the momentum is happening right now.
I can see that. Moving that data point forward completely changes how you perceive those analyst targets. It goes from Q3 was good and analysts seem to like it to something much more potent.
It creates this positive validation loop. So for a concrete example, you'd move the October 196% revenue data to immediately follow the Q3 results in Section 2. But crucially, you place it before you talk about the analyst price targets in Section 4.
So forward targets. You're showing that the analyst's $5.50 target is already being validated by preliminary Q4 traction.
The narrative becomes, Q3 was great, but the market really jumped because acceleration is confirmed. And look, preliminary October data proves the path to 550 is already underway. That structural change transforms the analyst section from just speculative optimism into near-term validation.
And you'd probably want to give that section a high-impact title to make sure it lands. Something like, I don't know, forward momentum confirmed, the continuous growth signal, or something along those lines.
Something that emphasizes that the growth story is ongoing and accelerating, not just something that happened last quarter. It really turns a strong report into a compelling narrative that guides the reader.
This has been a really targeted critique. I think to summarize the actionable steps for refining this report on NXXT, first, refine the narrative flow. Use that jump in gross margin to 11% as the analytical justification for the market's focus on revenue, and do it before stating the market narrative.
Right. Control the interpretation from the start. Second, strengthen the long-term view by explicitly connecting catalysts, like the CEO's insider buying, to the management of the $14.9 million cash burn and dilution risk, and define that break-even revenue number to give readers a quantifiable milestone.
And third, maximize the impact of that critical October 2025 growth data. That 196% YOY increase needs to be placed earlier. Use its current momentum to immediately validate those aggressive analyst targets and hammer home the theme of continuous acceleration.